with expense recognition and revenue recognition. But what we want to do here is talk to you a little bit about these multiple deliverables or sales with multiple elements. Sometimes customers will purchase products in a lump sum. And by the way, this next one we're not going to worry about. This next group I'm going to omit because this is talking about advanced collections, right? So you know that we've done enough of this already, right? We have advanced collections, the unearned revenue. What I want to do is go through right here. I want to go to slide 14, and I want to talk to you about multiple deliverables or basket purchases. This is something that's also very critical to the new revenue recognition standard, having a single transactions price and then allocating it to the pieces if it has more than one element. So for example, if you're selling a product and an extended warranty, you got to split the total selling price between those two products. In this case, we'll allocate them based on a relative sales value basis. So examples would be in software where you have training, maintenance, customer support are generally bundled together. So GAAP requires, if you have multiple deliverables, you have to allocate the transactions price between the products sold based on their standalone sales values. So the example we have here is a manufacturing company is selling off one of its plants. I'm going to give you another example in a second. And we have a selling price of $100,000. But the problem is we've got two separate ledger accounts. We've got land at $20,000, and we've got a building of $60,000. But we know the total sale is going to give us a profit of $20,000, right? You've got book value of $80,000. And you're selling it for $100,000, so you know you're going to have $20,000 profit. But the question is, how much profit is allocated to each one of those components? You go out and find out what the products would sell on a standalone basis. So if you just sold the land without the building, the land would have been $30,000. Now when we say market value, we say standalone values. What would you be selling the product for on a standalone basis? I would sell land for $30,000 and I would sell the building for $90,000. That means my total selling price should be allocated 25% to the land and 75% to the building. So what we would do here is say, all right, out of the total $120,000, the land represents 25% of the total selling price or the total standalone selling price, and the building is going to be 75%. So we allocate $100,000, 25 to the land, 75 to the building, 100,000 in total. The carrying value is $20,000 for the land, and therefore the profit on the sale is $5,000, and the building profit is $60,000 minus 75, or deducted from the 75, and that would give you profit of $15,000. So even though the total profit is $20,000, we had to find the standalone selling prices in order to come up with the profit on an individual basis.
Can you explain how you got the carrying value?
That's given. It's given to us in the problem.
How's that determined anyway?
I'm sorry?
Is that determined anyway, even though it's given, like, is that just?
Yeah, it would be given from the ledger. It would be the cost of the asset minus the depreciation. Land doesn't depreciate, so in your ledger you'd have a land account with a debit balance of, 20? And of course the building would have cost minus accumulated at 60. All right, now let me give you another one. And let me just sort of pull one together on the fly here. Let's use the dock cam. All right, so let's say that you're selling, and I'm just on a scrap of paper, put this together. So you got software sale. So let's say it's a software project for 8,000. So that's the project, it's 8,000. So when you sell this product for 8,000, you're including 3 components. You're including the software itself, the training, and the support. So there's 3 products together. It's bundled, or it's going to be a multiple deliverable. Now, the question is, how much? And the support would be like, and these haven't been delivered yet. So you only deliver the software, and these are contracts for future service. Now, if we would have sold these separately, you'd have the standalone price. So if you just bought the software, it would have been 3,000. The contract for training is 5, and the software updates and support would be 2. All right, so what I would ask you here, let me see a little bit more. So what I would ask you to do is determine the individual selling, or I should say, determine the allocation of that selling price to each component, and then make the journal entry. So let's take a couple of minutes to do that. Same principle as what you see up on the screen, but a little bit different application. So how much of that $8,000 is allocated to each? Relative sales value approach. Use the same model that you see up on the screen. You sold it for 8,000. If you were going to sell it individually, so for example, Rutgers right now needs to upgrade all of its computer systems because of the acquisition of the hospital and the medical school and everything else. Get a whole new software system for billing, for registration, whatever it may be. Everybody needs to be trained on that. It's a long-term contract, and we need to maintain that system. So we're charging, let's say, $8 million. If we sold them alone, we would have sold the software for $3 million. Training would be $5 million, and the support would be $2 million. So what I want to know is, how do you allocate that to each component, and then what's the journal entry? All right, so you should have the allocation. That shouldn't be a problem. So before we do the entry, what's the allocation? Anyone have those numbers? I'll put them up on the board in a second.
I have the software is 2,400. The training is 4,000.
Right.
And the support is 1,600.
Right. Okay. So the actual, so we have the product. Product, you have the software. All right, so the numbers are 3, 5. All right, so that's going to be 10,000. Of course, this is 30%. 50%, and that's 20. And if you multiply that out, it's going to be for 8,000. Sorry about that, it's going to go the other way. So there you go. So, under the new revenue recognition standard, it would actually operate the same way, but we got steps. The first step is to look at the contract, or how many contracts do you have? How many performance obligations do you have in the contract? We got 3 of them here. Then you have to determine the transaction price. By the way, this transaction price is fixed. It may not be fixed. It could be variable. It could be based on a bonus system or a penalty system, so that if you tell the contractor, if you finish within 6 months, we'll pay you $8,600 instead of $8,000. So the compensation could be variable. That gets very, very complicated, as we'll see next semester. But basically, you've got a contract identified. You've got the performance obligations. You got 3 of them. You have a transactions price, which is $8,000. Now you've allocated the transaction price to each performance obligation. Now you have to determine what is earned and what is not earned. And that's basically the new standard. There are 5 steps. So what is earned here? What has been delivered? What has been exchanged? What have you exchanged here at this point? Software is installed. Did you do the training yet? Nope. Did you do any service? So the journal entry that you would make in this case, let's say it's for cash, would be 8,000, and then you'd have I'm going to move that over. Software revenue, which is 24. Then you'd have unearned. For the training, and unearned revenue. For the support. So this has been delivered. It's fully functional under the assumptions that I'm making, and that means that it is exchanged. It's been delivered. That performance obligation has been satisfied. So that's when things get a little sticky with these multiple deliverables. We have to allocate the transaction. I just want to show the appendix. We're not going to cover this in detail now because we're going to spend an entire chapter on this in intermediate. But I want to go into the appendix itself. There it is. Okay. Okay. So basically, what we did here is really, although the same result occurs under the old and the new standards, under the new standards, that's what you have to do. You have to identify a contract with the customer. So do we have a contract? Secondly, what are the performance obligations within that contract? So right now, I've got one contract. How many performance obligations do I have? 3. I got 1 to deliver software. Training is the second obligation. The third obligation is support. Then, once you do that, you got to determine the transactions price. And you say, well, you gave me the contract. That's pretty straightforward. But as we'll see next semester, it's not always that is simple. Sometimes there could be variable compensation. So that if, as I said, if you install the software within 6 months, I'll give you another $1,000, make the contract 9. And then what you're going to have to do next semester, unfortunately, is take the probabilities and estimate the variable compensation. So it gets a little tricky. So the actual transactions price is not as straightforward as it is in the accounting 101 world. So you have variable compensation. You also have, bonuses or penalties. So that, if on my customer support, what if on the customer support, I tell you that, look, if you answer my employees' phone calls for customer support within, 8 minutes, fine, I'll pay you the $2,000. If it goes above 8 minutes, let's say it goes between 8 and 10, I'm cutting that down to 1,800. If it goes over 10 minutes, I'm going to pay you $1,000 for the support. You have to estimate the probabilities that that's going to happen. And that's how you're going to get the transactions price. So the transactions price may be 8,000, it may be more than 8,000, it may be less than 8,000. And then once you get the transactions price, you allocate it between the performance obligations and you recognize revenue as the performance obligation is satisfied. Once that software is delivered, it's fully functional, you recognize revenue. Until you deliver the training, you haven't satisfied that obligation. So that's the new mindset. So we basically took what's in the textbook, which is the same answer you're going to get here, but using the new framework. So that's what the new framework looks like. So next semester, we're going to spend a lot of time with how to identify a contract, how do you identify performance obligations, how do you know if the contract price is fixed or variable, and then how do you allocate it. Most of the allocation will be relative fair market.